In Stocktwits Nation, we have a very special show today. It is Tuesday, April 15th. It is tax day. Did you guys file your taxes? Yes?
I filed my taxes, bought a car, spent stupid amount of money on suits all in the past 3 weeks, and I feel dirt poor right now.
Right.
That's why I'm hoping the market bounces a bit so I can like build my cash position again to add. But yeah,
Right.
I hate tax day. I'm one of those.
I'm
I know
gonna
those
get
two
to mine
camps, like,
later
one camp
today.
is-
Yeah, I got a couple hours blocked. It should be fine, right? Like no problem. Before we get into it, let's why today is special. We got Bret Kenwell here from eToro. He is the U.S. investment analyst. Amazing purview into retail investor behavior, and I cannot wait. We cannot wait to pick your brain about what you guys are seeing. Welcome to the show.
Yeah, thanks for having me, guys. I'm like to tune in from time to time, so to hang out with you guys will be fun.
Oh, you don't watch every day?
Okay. I wish I could watch every day.
Kidding. Okay, well, we're going to start off. Let's run down some of the news items, catch up for the day, and then I'm going to tag you guys in. I would definitely want to hear your thoughts on all of the things that are happening. But let's get into what we're seeing so far this morning. First up, tech exemptions sparked day 2 of green. The market stayed in rally mode on Monday after the White House announced tariff exemptions for all computer-related goods. Apple leading the Mag 7 charge. And FinTwit was tipping its cap to Tim Cook for swaying the president. Nvidia pledged a $500 billion investment in U.S. AI infrastructure over the next 4 years, which Trump promptly took credit for, though he warned the exemptions were temporary just in case. The major indices closes. S&P was up 0.8%, NASDAQ up 0.6%, and the Dow Jones up 0.8% as well. We also saw some meme behavior happening. So it's been a minute since we've seen, I guess Newsmax was the latest meme trend, but Webull snuck out with a SPAC IPO on Friday. I didn't even register this until yesterday when I saw everyone using the Bull cash tag. That's kind of a money cash tag to have, but their shares explode 374% Monday. Friday was kind of quiet, but it was a $7.3 billion SPAC merger, and that gave the Florida-based China-connected brokerage a $30 billion market cap. Overnight trading saw prices begin to cool, but definitely one to watch today. Let's go back quickly to the Nvidia news, and I want to ask you about this, Shay, because this announcement, $500 billion investment into U.S. AI infrastructure over the next 4 years, that's an eye-popping number. A lot of people's heads turned. In your view, is this a transformational moment for domestic AI development, or is there a risk that the headline number outpaces the realistic impact? What are your thoughts here?
No, I mean, I think this it cost them $500 billion to get in Trump's good grace. That's what I read from that. I was like, all right, well, now they're going to help Nvidia out on that tariff mess. But I spoke about this yesterday when I was on Fox. Like the disconnect that everyone's having on Nvidia is people view them as a hardware company still, when that's just not the case at all. They've evolved. They've morphed into the full kingpin of the new digital economy. It's not just hardware. They have a full ecosystem that's pricey, but the reason people stay in it is because of their CUDA platform, which essentially creates this it's a software component of their ecosystem that creates this virtual environment for you to test algorithms, test all these things out before having to deploy them. That is so vital in any early sector growth theme. Doesn't matter if it's AI, quantum, robotics, like you're going to want to test these futuristic algorithms that's never been done before in an environment where it isn't costly. It's very hyper efficient. So Nvidia's here to stay. Like people keep saying like, oh, their GPU business is going to probably start getting cannibalized due to the margins, or their the best days are behind them, and now their gross margins will go towards 50%, and those days in the 70% range are over because the pricing power is getting removed due to DeepSeek just revealed how cheap training data is going to become. No, no, it really isn't, because inference data is about to explode, and then CUDA platform is going to benefit substantially from that. The big argument though with Nvidia, which I'm on board for, is nobody knows a one-to-one. The headwind on the GPU side of the business and the tailwind of their CUDA side of their business, nobody knows how one-to-one correlated it is. So in the near term, during this digestion period we're in AI, it could get a little noisy, but these kind of headlines relieves the heartburn a bit, knowing that, all right, so there's going to be some government project initiatives that might help relieve that heartburn. They call it the Pepto-Bismol of headlines for Nvidia shareholders. And I do think it's a nice sentiment win, and we'll see in this earnings season how all this geopolitical madness is affecting their bottom line.
Yeah, I love how fired up you get when you talk about that company and others. And speaking of Pepto-Bismol,
I don't even own it. That's a crazy thing. I don't even own Nvidia.
but you're just excited about it. And I want to bring you in, Bret.
Yeah.
Speaking of heartburn, retail investors, it's obviously been pretty volatile. You at eToro see a lot of data, see a lot of things. What are, and we're going to get into so much of it, but at a high level, this volatility, how are your users reacting, and what are you seeing in the platform?
Yeah, I think when it comes to retail, to me, I think they are more confident and resilient than I would have expected, to just be perfectly honest with you. The type of like market, the type of tape we're working with right now is one that we are, or it doesn't come along that often. I think it was the fifth fastest 10% correction in like 70 years or something. A couple of these two-day price action were like to the financial crisis, the 87 crash, COVID, the depression, not exactly, eras that you want to realign with. And yet retail's actually been handling the news pretty well. They've been, whether that's, actual, we're looking at actual data or looking at the survey results we did. So we did a survey in February. So we started it February 18th, which basically top ticked the market. And it ran through March 4th. So it caught like not quite half of the correction, but a pretty good chunk of the beginning. And in it, we had like some of the survey results, for instance, like one was like how confident are you in your long-term investing goals? And I think that figure was 66% that were like highly confident. It was the highest number. We've been a survey for a couple of years every quarter. That was the highest number we had for that response, which was surprising to me. I don't know. I just didn't think that confident coming out of this type of mess. They've been buying the dip. They've been actively staying involved with the market. We saw that going all the way back to the DeepSeek news in January. They really stepped into Nvidia, into AI, into some of the levered semiconductor ETFs, which we tend to be more of a trading vehicle than an investing vehicle. But since then, they've been pretty steady. We did cool down in February, but then in March and April, they've been active.
Yeah, and we have seen a lot of retail flows. I'm trying to pull up data I saw, but I believe it's higher than kind of the COVID boom, higher than the meme stock frenzy, to your point. And let me know if there's anything you aren't able to answer, but are you guys seeing that same sort of trend on flows into the platform as you are volume?
Yeah, so I think what I can say in terms of our platform on our side of the platform is day after Liberation Day, that first big day of this latest downturn. So like that really first like really nasty harrowing day. We had, what was it? I think our buy orders were up 50% versus like the average day in March. So basically the prior month before was up like 50% in that one day. So it was just, and they were really stepping into the beaten up tariff names. I know Nike was in the top 10. I'm not sure which number it was. I think Nvidia was number one. And I know like Amazon, Nvidia, Nike. So really the names that were kind of like the center of that tariff worry. And retail is, you know, they go to the names that they know the most, like, and that's tech and consumer discretionary, which, you know, unfortunately for retail is, you know, the two sectors that are doing the worst. I think they're like the only two underperforming the S&P year to date. It just happens to be like that's the biggest allocations for the index, but it's also generally the biggest allocation for investors. They're the brands they know and love. So I'm impressed with their resilience. I'm surprised that they're so optimistic, just given how poorly those groups have done.
Yeah, I mean, it's interesting. If you entered the market, and like a lot of people, probably in the cohort of users you have, I'm sure it spans everything from boomers to Gen Z. But if you came in around 2020, turbulence is sort of the normal. And this is like a cohort of people that is like growing up with crypto. Like, I feel like volatility is so much more digestible for this audience. It's not to say everyone loves seeing these types of drawdowns and swing arounds, but it seems like they're kind of just used to it. Would you say that's the case among eToro users?
I'd say 100% that's the case with not even just our users, but retail users in general. I think the reality is that we've done other survey work that's outside of this quarterly survey, like more specifically around like options and like investors' approach to markets. We're not seeing them scared away from events. If they take their lumps like everybody else, they learn from it, they digest it, and they look, you know, to be better the next time around, whenever that. Unfortunately, these times have come around a lot in the last 5 years, but they're not scared away from the markets. And I think you're right when you mentioned like basically anyone who's entered since COVID or around COVID, they're just kind of used to these drops. And I think that they see, for better or for worse, how quickly these rebounds can come to life. Whether that's like the long-term statistics of the S&P, and they know, hey, this is a good long-term vehicle, even though these dips suck and they hurt and they're painful and our portfolios turn red. They know that there tends to be this rebound, and specifically into the names that they love, like Mag 7, a lot of the consumer discretionary names, the names that they know and love, they also tend to come back historically in a strong way.
Yeah, I think it's going to be interesting. Shy and I have been talking a lot about earnings season coming up. I think we have a chart we can throw up that shows the retail flows in March, which I think is an interesting one if we could throw that up quickly. But I do want to turn to some of the earnings. This week we've had some bank earnings. Yeah, there's the chart. I think this is always an interesting view, and you see this at year end, Bret, but people assume these are times when people retract from the market, and it's sort of the opposite. And where maybe institutional investors don't have the stomach or the risk appetite, retail does. But I want to let's go into earnings, because we had some banks reporting this morning, and there was some trends. I want to get your guys' thoughts on these. So this morning we had Citigroup Q1 earnings beat, similar trends as Goldman yesterday. Equities trading was up. Profit rose 21% to 4.1 billion, but the shares are down 10% this year. And Bank of America, similar story. Profits were up in Q1 11% to 7.4 billion. Just like Goldman, their investment banking fees slipped 3%. Same story as Goldman, lack of M&A activity, overall just pause, paralysis in the market. Shay, hearing these results, hearing Goldman's yesterday, any of this surprise you, or is this about what you were expecting to hear from the banks this week?
Yeah, so this is definitely not my lane. Caveat, not my lane. I am a thematic investor in tech, but I think it makes sense that these banks would report strong earnings because volatility. They benefit off volatility on their spreads. I think the looking at Citi's performance specifically, like I do think the big caveat was it was a great print, but the credit cost is I don't know if that's a hiccup or that's something bigger. They missed on their credit cost estimates for 2.6 bill. They came in at 2.7 billion. So that's making me think, oof, like that is the narrative right now, and that's happening in that space. That's not good. Going on Bank of America, I mean, they're just like, look at that revenue beat. That's substantial. Like estimates were 25.8 bill. They came in at 27.4. Like that's what I'm saying. This is the kind of time environment where they do make a lot of money at their desk. However, they missed on their net charge-offs. That's not good. And their credit losses were a miss as well. Like it's somewhat of a theme, but again, not the expert in this at all. But I feel like this was a good enough print across the board in banks that maybe this earnings cycle won't be as severe on the consumer side as people anticipate. But I disagree. I think it's going to be a pretty bad earnings cycle. And these traditional banks maybe aren't showing them the impacts right now, but I think the other ones, like what Brett was talking about, tech and consumer discretionary, like those business spending and discretionary budget, those are two levers that get pulled ASAP when there's a macro shitstorm that we're in right now, because there's no confidence in the market right now. There's zero confidence because Trump could say one thing, Lutnick could say something completely different within hours later. That's causing second guessing across the board for C-suite. That's going to affect CapEx spend, hiring freezes, business spending for growth initiatives. And it's also going to affect the consumers because they see the headlines like costs are going to go up. So now they're like preparing for the worst, and they're not going to spend as much as they would as on the discretionary budget. So those are the two levers that get pulled ASAP when things are going bad. That's what we're going to see this earnings cycle, and I think it's going to be somewhat of an anchor on any kind of rally we're in. And you saw it yesterday. Like even we couldn't really hold the rally from yesterday. Today it's like flats. Like what's the next catalyst to really buck this trend when we're 8% below the 200-day moving average? Like we have a ways to get above the 200-day moving average where people will stop being defensive. And I don't know what's going to take to be. It's going to maybe Trump posts like Z just called me on my cell. Like we're all good, bros. Like we're gonna be good. Like I don't know.
Yeah, I mean, the economic policy is a little bit all over the place, and we don't really speak to our thoughts on that other than what's happening, which is we hear a lot of things, and I know it's weighing on investors. And Brett, I'm curious kind of what you see in your community. It's funny, it kind of messes with your head. Yesterday I was telling Shay, I'm like, I'm so confused about the tech tariffs. And then I was reading The Hill this morning, and it was like tech companies are confused, and I was like, oh, good, like it's not just me. What do you see and hear, either hard data, survey data among eToro users? This policy overhang. How is that impacting their behavior?
I think when you look at like when you are dealing with surveys and it's not just like our surveys, but any surveys that like have to do with sentiment or like what people are doing, it's easy. It's not always the same as like they say one thing but they're doing another. You know, I don't think that's uncommon. It's not uncommon to say like, oh, I feel like crap in this market, but I haven't capitulated, or like I'm not reducing my exposure or adding to it, or however. You know, their actions don't necessarily have to be what they say they're going to be. But I think Shai's right. I mean, when you look at the current approach to global trade, it's just creating too much confusion. There's too much chaos. It'd be such a more straightforward approach to say like, here's the tariffs to go away and they're going to stay in place. And I'm not saying that's what they should do. I'm just saying if it was at least something that business leaders could plan around, then it's something that analysts can model. It's something companies can model. But where we stand now, it's just it changes too frequently and in too much of a magnitude for anyone to feel confident. And we see that in investor sentiment. We see it in business and consumer confidence. I mean, if you're a leader of a large C-suite company or of an S&P firm, how are you possibly committing to major projects or major decisions in an environment like this. You just don't know what's going to unfold over the next quarter or two, or even really in the next day or two. And that creates a wait and see. Like, I mean, you're literally seeing like a wait and see approach from everyone, from consumers to businesses to the Fed. And that puts us, that pause is ultimately a risk. If it goes on, if it goes tractions and worries that kind of outpace the current situation.
Yeah, it is.
Yeah, paralysis. That's the word of the year,
Yeah.
paralysis. And I think it's going to not go away anytime soon. Confidence takes time to build back up. Like, it's not a V-shaped recovery. Like, imagine like you're in a great committed relationship, and all of a sudden like your partner cheats on you, and like, all right, that was a slip up. Like, I trust you won't do that again. You're not
Whoa,
gonna have that
Shy.
trust. Will take time to build back up.
You're very forgiving.
So like, it's the same thing. Like, it's just hypothetically, like,
I
the
know.
equity markets and consumers, like, or retail investors, like, it's a similar type of trust that we had. That all of a sudden, global trade policy got blown up, and now these figureheads are saying conflicting messages. They broke our trust, and now it's gonna take some time to build back up. It won't be a V shape, and that's the issue. He broke something, and it's gonna take some time to build it up. Might be beneficial for the U.S. economy in the long run, but in the short term, near term, it's going to take some time.
Yeah. I mean, I'm Italian. That situation would be done. But I will say, I want to ask you this, Shy, because you have purview into corporate strategy, and when things are sort of turbulent, everyone thinks about, okay, what's like the layoff, labor implications. If there's paralysis in decision making around things like M&A, opening in new markets, things like that, what point are the decisions made about cutting headcount? Like, are they thinking about that right now, or are they waiting and seeing on that front as well, in your opinion?
As soon as they see margin compression from the post-tariff implications, first lever, always FTE. Always. What segment of our business can we reduce the FTE that won't impact, that have the least amount of impact on our top line growth? That's immediate. The conversations are already happening right now. To be honest, it was already happening because of all these AI tools now. You heard Shopify CEO just come out like a week or two ago saying, for now a business case on an open rec for an FTE, you need to add language on why AI can't do that. That is going to be the status quo. It's going to be. So now it's becoming even more difficult to greenlight open recs because there's a imbalance right now on margin compression without the revenue reaccelerating. It's because of this macro environment. So like, I do think we're going to have middle management get blown up completely in the agentic AI world we're about to enter. But now with the macro landscape just accelerating that, it's going to get ugly. And it's also coming at the same time where there's going to be hiring freezes. Like what Brett was referencing, like C-suite doesn't know the sandbox of risk right now. They don't. They have no way of controlling their risk. It is in a way spiraling because of this ego-driven high-stakes poker game we're playing on the East versus West that just keeps escalating. But it sounds like we're now in a pause mode, which is great. So maybe in the next 3 months they can control their risk, knowing this feels like this is what's going to be on the table for the next 3 months. So now we can adjust accordingly. But those hiring initiatives that you had for entering 2025, like, oh, we want to tackle this growth lane for our business for 2025 via CapEx, via hiring FTEs, we're going to put down the sidelines because we just don't know after 90 days if things will escalate. That's the paralysis I'm referencing. That's going to be detrimental for the economy, for GDP, business spending, and discretionary budgets.
Yeah, I didn't think about the economic volatility alongside the AI pressures with the Shopify news. We have this chart I saw was really interesting. It's on the startup level, but it's from CUDA, showing over time how startups at various series stages are leaner now than they were a couple years ago. It makes sense. 2021, I was at a startup. We were hiring like crazy, and then 2022, haven't we cut back? A lot of cutbacks happened, and then people realized they could do more with less, and that sort of dovetailed with these AI tools coming to mass market. And so I'm wondering if you're going to start seeing this type of trend on the public company level too, and even, you know, are investors going to start looking at things like headcount? I see sometimes you guys probably notice people talk about certain stocks. I think DocuSign, I see a lot. People are like, why do they have 7,000 employees? Like, it's starting to become something that investors really look at. Do you see like metrics like that growing in importance, Brett, among your investors in eToro?
In terms of like how AI will impact like the bigger
Or,
picture.
yeah, like what other what are they looking to besides the stock price? Or like, do you have any insight into how these decisions are being made? Are they looking at things like, you know, how heavy their head count is versus where it should be? Other metrics that maybe weren't important before, but are sort of on the radar now.
That's a good question. I mean, I think that would probably depend, go from like investor to investor. I think generally, like when it comes to retail, they tend to kind of like do things in a couple of different, I don't know, I call them like buckets. They have sort of their like long-term safe approach to markets, which would be like their 401ks where they're more disciplined, more consistent. They just DCA. When it comes to their investment accounts, kind of longer term but discretionary trading, I think they do tend to take into a lot of different accounts. Like we have, it's such a wide range of like what their calculus is for picking a stock. Like some people are just technical, some just fundamentals, some blend them. So it's what but then, you know, there's always that bucket too where it's sort of like their, I don't know, like their fun money, their play money. And that's where they're more aggressive with, you know, like inverted ETFs or with options. And they're okay with the fact that, you know, they can lose most or all of it, but they're looking for that sort of like that moonshot with it. So I think it just depends honestly on the investor for that stuff.
Yeah, I think that's something that sometimes gets missed in the narrative about retail investors, as you'll see stats, increased usage of leveraged ETFs, increased usage of altcoins, but that's alongside other things. And to your point, I think there is this like part of the brain among retail investors. They were like, this is like my like YOLO center and I'm going to go nuts. But maybe the rest of it is like T-bills or something. Like, who knows? It varies. But I think sometimes when you see the headlines about options activity, leverage products, you think that means everyone's shifting like allocation wise, when it could just be adoption in general is going up alongside other things. Is that sort of what you see on your platform?
100%. Yeah, I mean, there would be days where you see like Bill, like BIL, the ETF was like, you know, it was hot, or like VU. You know, you see the names like that, and that's like, I feel like their disciplined approach. You know, that's them being. But then there's other days where, you know, you'll see a levered ETF in the top, like a Soxel or something in the top 10, and it's like, okay, they're, you know, and that depends on the environment too. You know, your slow, boring days, you know, they're not loading, you know, there's nothing to really do. But then when you see opportunistics where we see these giant drops in the market, for instance, they're like, okay, like I'm going to position myself for a bounce. Maybe we don't get it, but like we're going to try.
Yeah. Let's shift to some news that came in overnight, early morning hours. Boeing, China is halting some of their orders from Boeing. Obviously, things are escalating rapidly, even though it seems like we're sort of in a lull on the tariff news. But this was a big news item. So China had its airlines stop new Boeing jet orders and deliveries in response to the tariffs. Shares dropped 3%. There was about 180 deliveries to Chinese airlines scheduled in the next 2 years that are now in question. Context, China represents 20% of Boeing's global aircraft demand, so it's not a majority, but it's, you know, decent chunk. And beyond the deliveries over the next 2 years, you know, thousands more after that. So what does this do to Airbus, to other competitors? I think it shows just how all of these decisions that are happening are impacting all sorts of companies and pockets. Boeing wasn't one people were talking about. Everyone was kind of talking about the tech and the chips, and now they're in play there. Shay, any thoughts on this? Do you think China will maybe make more moves like this where they're actually banning certain high-value U.S. products from even coming in?
Well, I call BS on this headline. China could say whatever they want on it, but Airbus can't handle that demand vacuum that just got created from China not buying Boeing. Like, when Boeing had that whole fiasco, they probably still do, but on like their planes were just going down. Like there's some sketchiness happening on building those planes. Like Airbus literally could not keep up with the demand. Like it back then, like they just can't keep up with the demand. Like they just don't have the infrastructure. Like it takes time to build these planes, guys. Like it's not as simple as like, oh, just spend spend a 20% more time to create these planes and you should be fine. No, it's not like that. So I do believe that like fine, China might halt the Boeing deliveries. Where are you gonna go next? Is a duop the world has a duopoly
Yeah.
on these planes. It's Boeing or Airbus. Airbus has been very vocal. There's multiple year back. They're back behind their pipeline. Like it's gonna take if you place a new order, you're gonna have to wait years. That's
Yeah.
like that's the issue. I think it's called BS on this, but again, it's an easy headline to call out for leverage in East versus West, and I think that's exactly what China's doing, and that's why it's really important to like kind of look through the noise and not react. You're seeing it down 3% pre-market, okay, but I call BS. I think it's fluff, leverage that won't become substance, and there's gonna be more headlines like this. You're gonna see some headlines in all industries. They're just gonna be throwing it out. Just honestly, look at the show Veep, like on HBO. Like you can see how ridiculous some of these like kind of headlines are. If you watch that show, it's all an act. It's all just like
It's
I'm gonna
not
throw
that
this out
far
there and see what
off.
sticks. Yeah, it's so like that's my 2 cents on it. I call BS.
It's a great show. I think you're totally right though, because I saw the 20% share. There's opening market, and then the 3% decline seems low if it's 20%. So I think you're onto something there. Let's do a quick check of the markets. See where we're at in the morning here. We are down a little bit, but relatively flat. So Dow futures down 0.1%, S&P futures down just 0.02%. So NASDAQ futures slightly up in the green. Not a lot of change since what we were seeing in the pre-market. Let's turn to some other news that we've been following here. One of the things I noticed this morning was some news out of LVMH. And I know, Shay, you're not a luxury. I'm definitely not a luxury expert, but this is always interesting to read about this company because they touch a lot of areas of the consumer space that are potentially impacted by a recessionary environment. So they actually got dethroned by Hermes. Shay, you know, right? Is it Hermes?
Hermes, yeah.
I was gonna say Hermes. That's Hermes. So they're no longer the most valuable luxury stock. That says everything you need to know about me and my upbringing. But really interesting also within this is LVMH also has a wine and spirits business, and that took a hit. And that could be more so due to just consumer behaviors of people are drinking less, young people are drinking less. So their shares are down 8%. I'll go over to you, Bret. Like these types of names, these have a lot of cachet among consumers, and retail investors are consumers as they are investors. Do these consumer brands get a lot of attention, either watch list or investing on eToro, just because they're recognizable?
LVMH, not so much on the US side. I'm sure like globally, we probably have a different, I'm sure like our European clients probably have a different approach. US wise, not to my knowledge. I'm not really sure. In general though, just to see sort of how the stock has performed lately is because this is your higher end clientele, your higher end spenders and your consumers. I mean, at the end of the day, like their money travels far around the world. So it's the stock actually held up pretty well in the last bear market, so like 2022-ish. It just has not held up so well this time around. So there is a concern there, but it is, company specific issues that, have plagued them as well. So I don't know. I feel like LVMH is kind of a mixed bag when it comes to retail's approach to it.
Yeah, I think that's a great point. It's a theme that's been coming up a lot in the last few days of what is actually impacted by the macro versus what is a business level issue. And Shay, even when you were talking about Boeing, I was curious, you talk about CrowdStrike a lot and during their big fail. Boeing also survived, maybe not to the extent CrowdStrike did, but Do you see Boeing as another example of that, where it's like if Boeing can't get taken out completely by what happened in the last 12 months, like what does that moat look like?
No, it's massive. That's why I love investing in duopolies, monopolies, duopolies, because like there's a huge cushion on error, and also a lot of pricing power when things are going right and you don't f up. You have pricing power now. You can just continue to upsell, upsell, upsell. Boeing hasn't really been able to upsell because it's just such a shit show, but they also haven't failed like you would think. Like same thing Intel. Intel had a massive um, advantage, and they should not be a real company right now for how much they missed this past 10 years, but they are still. And they're so essential that we need TSM, which is they're doing it right on the Taiwan side of the world. Bring your expertise on the US side so you can help out our trouble child Intel. So that's why these like competitive advantage and moats matter so much to me specifically, and why I look for like early disruptors and secular growth themes that have these moats. Valuation, like yes, it's tough to swallow. Like adding Axon at 400, adding um, CrowdStrike at 250, like Palantir even like $40 when I added it back then. It sucks. It's tricky because the traditional metrics are overvalued, but you have to price in their competitive advantage, their moats, and what the future is going to look like. And that's kind of why I put a lot of weight behind my decisions. Going off of LVMH, I do also want to make some commentary on that because I did look into the reports. And why did I do that? Because this is not my growth lane. It does affect one of my stocks, Global E, ticker GLBE. This is one of their biggest clients. So when I saw the headline that there's a softening on global luxury in the two markets that matter the most, the US and China, I'm like, oof, great. So that's going to be an anchor on Global E now because I just don't see them out with everything that's happening geopolitically. Cross-border e-commerce is going to take a hit. That's one of those things where second guessing will be impactful. And what I heard from LVMH yesterday is things are not going well at all. There is a ripple effect that's happening, and they're like their strategy on how to kind of offset the pullback on marketing spend or like the international launches is to promote high ticket SKUs online. And I do think that they're trying to kind of consider price hikes to absorb the pressure. Like, I don't know, like $2,000 handbag might be turned into $2,800 or $2,400 at checkout. Like, that's not just a sticker shock. Like, that is somewhat of a sign or a pre-read to me that even the premium buyers out there are second guessing if this is worth it. And that's what's alarming, where it's not just the lower class, middle class. It's classless now, the second guessing. And when it's classless, you just don't know who's affected and who's not. Because before, the luxury good market is like, all right, well, the rich will always keep buying. Like, that's kind of a safe haven. We got something completely different just this week. And now nobody's safe. And that's the worry.
Yeah, I mean, something you brought up remind me. I read this headline over the weekend that a majority of people at Coachella actually use BNPL to pay for their tickets, and I'm wondering like where that factors in, right? So if it's, I don't know, like a 2,000 versus 2,600, like if this headline was fascinating to me too. I mean, it makes sense. They're about $500, $600. It's an expensive trip. Shay, have you ever been to Coachella?
No, my fiance hates me for it because 5 years ago we were supposed to go, and I was just like, I pulled it out last second for us.
Who'd you miss?
We've never gone, and we're probably never going to because I'm 31. I'm a little too old.
How about you, Bret? Have you been?
I miss
No,
Kygo.
I've never been.
You missed Kygo?
No, yeah, it was 20. It was 20. It was 2015. It was 2017. I missed that year. It was a
Okay.
great year.
Yeah.
I missed that one, but I lived in LA my whole life too, and I've never gone, so that's actually pretty shameful. I do
Yeah.
feel ashamed for that.
I mean, a lot of people saw that and they were kind of pissed. I don't hate it. I feel like you shouldn't have to be super wealthy to go to a music festival, but I think that does say something. It'll be interesting the elasticity of people's willingness to pay, given that they can chop it up.
Well, it's the mentality of like, oh, like it's Future Shy's problem. He'll figure something out. That's like the worry because now there's more pressure on Future Shy, and that can snowball really quickly. And you never know if an accident happens. God forbid, knock on wood. That now I have a fat bill I couldn't account for, and I have all these buy now pay laters that I was anticipating Future Shy to deal with. But now Future Shy is at a different situation than current Shy, and now I'm suffocating. Like that's the worry of like things snowballing. So like I don't love to see that. I don't love paying for fleeting moments with kicking the can down the road. I do think that will break something eventually, and that was always my biggest disconnect with the firms out there. Where like I don't know if this is like a good thing at all. This might be really bad. We'll see. But yeah, that's my 2 cents.
Yeah, so a firm, we interviewed their CFO, Bret. He was on one of our shows, and he was talking. This was like when Tariff was like right before, and he was saying we were reading him comments from Stocktwits, and someone's like, "Oh, you seem like an easy short because of tariffs," and he said, "Actually, they're well positioned in that environment, which for logical reasons, but they're obviously their stock's been taking a pretty significant hit." In that environment, and then of course Klarna was supposed to go out and IPO. That's on pause now too. So, what about these BNPLs, Affirm, some of these fintechs that are consumer products? Do you see a lot of interest in those among eToro investors in the U.S.?
Surprisingly, like the survey, the quarterly survey, like there's a specific on allocations, and some of the things that jumped out in the quarter were like every sector in the S&P saw its allocation go higher for retail investors, which was surprising to me. Just because they don't have to be a group that's like solely focused on diversification. It's almost like a concentration in sort of like their favorite groups. But ironically, tech was not the favorite or the highest allocated in the quarter. It was financials, and we've seen that for a couple quarters in a row, which is inclusive of fintech in this light in the spirit of this survey. But so I would say retail is pretty well attuned with fintech and with whether that's buy now pay laters, whether that's your more of like your Squares or even like even your traditional banks. But in general, like they do have an affinity for this group, a really big affinity for it. I would have thought tech would have been their hands down, no questions asked, their favorite.
Yeah, it's almost like everything's tech now, everything's fintech, and they're moving around a bit. You brought up diversification. I'm curious, we've obviously been watching, Shai calls it a rental, but gold continuing to kick up. Gold is not something that young investors are typically known for investing in. What are you seeing among like gold ETFs, precious metals, commodities? Are some of these sort of like boomer moves, are they resonating with younger investors who might be diversifying?
Yeah, they are definitely resonating. I would say it probably helps that gold had, like, I don't remember how much it rallied last year. Was it like, Shy, maybe off the top of your head, like, I think it was like close to 30-40%. Like, it was a pretty monster year for gold. And then to follow it up with like a very strong Q1, up like 15% this quarter, or the prior quarter. So gold has been this like very it would typically be classified, I think, as more of a like a baby boomer type of asset, maybe like a little Gen X and above, of course. But we've seen in this quarter, Gen Z has actually had quite an affinity for what we classify as commodities, but the read through for that really is like silver and gold. And just to say a note on Gen Z, by the way, like that's like our youngest cohort that we measure, obviously. And, I think we get this sort of perception of not only retail investors, particularly like young retail investors, like that they do what they're doing, that, they get like the moniker of like dumb money, which is, which I don't think is fair necessarily. And they're young and inexperienced. So you just don't expect them to be like making the right moves in like a manner that you find acceptable, I guess, if you've been around in the industry for a while. Gen Z has done, and this was like really crazy to me because in Q4, when we did our last survey, it was like the second half of November through that first week in December. So it was really right after the election, everything was ripping. Bitcoin, stocks, metal. Like it was just like a monster rally. And Gen Z was like moving to all these risk off assets. They're moving into bonds, they're moving into cash. And I was like going through the data. So like we get the data back in January and I'm like going through and I'm like, what is Gen Z doing? Like, why are they, it's not only is it like flying in the face of what's happening in the market, but it's also like the complete opposite of what you'd expect from like a risk on type of group. Just a young investor is not typically like, hey, let's buy bonds and cash. They're usually in the stuff that's, you know, has the potential to move higher significantly. And so I was like, that was weird. But then in this quarter, they're moving completely back the other direction. Like they're moving in the prior quarter, it said they're allocated to cash. That fell all the way down to 60, which was pretty low. And then, you know, you saw a huge increase, like very substantial increases in foreign and domestic stocks. Both saw big increases, a big increase in commodities, big increase in crypto. So it's like, to me, I'm just looking at this. I'm like, did Gen Z just sell the high and is now trying to buy the low? And if they did, kudos to them, because that's, I mean, that's amazing finessing of the market right now.
Yeah, I'm like, what did they know? Was there some sort of like TikTok thing going down this summer that was like, hey guys, precious metals? Like, it's wild, and I think you're right. The dumb money thing has kind of been disproven. But I think the other side of that is, it's, you know, people just starting out in your platform. You know, you probably have people with a lot of money on there. You have people starting out who start with a little. It's okay to mess up a little when you got a little money in there. That's how you learn. And I think, you know, even when I was at a brokerage, we saw a lot of diversification and like quote unquote healthy investing behavior happen after periods of volatility because people got those quick gut checks. Before it was like they're moving their entire 401k or something. It might have been, you know, a few $100. So I think that'll be interesting too, to see like after this, how they grow and where they go from there. I want to check in quickly on the trending list on Stocktwits. So this is the list of what's popping in the Stocktwits community. No surprise, Boeing is up there. Bank of America, obviously, their earnings. Netflix is popping a little bit today. They have earnings on Thursday, I believe. So they're up over 3% today. I think that's going to be one to watch. Shay and I kind of touched on it yesterday, but obviously backward looking data, but they're making moves in sports, in gaming. It looks like people are feeling decent about their earnings. On these like entertainment streaming stocks, Shay, do you play with any of these, or you stick into defense and AI mostly?
I mean, as a growth investor, I kind of want to figure out the next multi-bagger. It's kind of tricky with these names on what if it'll be. A lot of them's priced in on their moats and advantage. Like for Netflix, if you zoom out past 5 years on the chart, the time to add was when the moat was getting tested during the streaming wars launch, and like I think it was 2022, because the narrative was, oh, streaming's a commodity now. They had a first mover advantage, but it's a commodity, and you're seeing Paramount, HBO, Amazon Prime, like everyone is creating their own streaming app that the glory days are behind them because everyone was licensing their IP to go on Netflix because they were the only streaming app out there. But now there's so many different optionalities that what's Netflix going to do? That was when you add. That's why I love adding when there's blood in the water, because if you had the conviction, you did the research, you knew that was BS. This first mover advantage created business economics that nobody else can duplicate. And my voice just cracked right there for the first time in, I think, half a decade. And then I think that was like the gut check of like, oh, this is happening and we're actually having pricing power. We can upcharge our users, and like you're seeing all our competitors like not being able to go close to profitability, and they're never going to. The only way they can is through maybe synergetic partnerships with their competitors, but even then it's hairy. Netflix proved like, oh, okay, they have a mo. They are this entertainment streamer for potentially ever. Who knows? Nobody can solve this business economic model like Netflix can. And now they went from what, 200 to 1,000 within 3 years. That only happens when there's a narrative disconnect. Right now, there is no narrative disconnect on Netflix. It's being priced with a premium valuation, well deserved, but it's being priced accordingly to that. Same thing in Palantir at what, $100. It's being priced as what I envision them being in the future. Time to add a Palantir was under $10 when everyone called them a black box consulting company, not when everyone's saying that they're going to be the operating system of AI. Like that's not when really you should risk the biscuit. But for Netflix's upcoming earnings season, for this Thursday, I think they're reporting Thursday, their first big tech company to report this cycle. They are the most protected among the tariffs, among probably the big tech. Like they're not going to be as impacted as you would think. The way they hedge and currency wise, like it's going to be fine. However, this is the first real gut check on their ad business. And I think
Mm.
that's where my eyes are going to go because I do own Trade Desk and discretionary budgets is impactful for ad spend in a recessionary environment. That is the first lever you see get impacted when we have talk recession is ad spend goes lower because wasted capital is every C-suite's nightmare. They wake up in the middle of the night screaming, wasted capital, no! Like that's exactly what they don't want to do. That's going to pull the lever back on ad spend. And I want to see how Netflix reports their ad side of their business. I wish we can see their subscription numbers again, but like they took that visibility away for a good reason because the juice has been squeezed. They don't really want to show the maturity of password sharing protections now because it's probably not going to be as juicy as it was in 2024. But that's where my eyes are going to go on Thursday, straight towards how's their ad business doing because that will have implications for Trade Desk and
Yeah.
Magnite. Maybe even some read-throughs for Meta and Google because of YouTube.
Yeah, and the Netflix front, it's interesting as well. They're because of the tech stack they have, they can more easily measure the efficacy of advertising versus it's harder to do in typical television streaming, and it's even harder when you have a game that's on broadcast and a game that's on streaming. If you're a pure play streamer in Amazon, it's easier to show exactly who is watching, targeting, and so it'll be interesting to see how budgets shift among even the streaming platforms and the major networks, and if that chasm grows. Bret, I want to bring you in. Any insights from eToro investors on either Netflix or the streaming wars from an investor point of view?
Yeah, I think Netflix is sort of like interesting because it was part of that original like FANG, acronym on Wall Street, and then it kind of like fell out of when it became the Magnificent Seven, like it was just not included, which I think is sort of an interesting way. I think it's not forgotten, but it's not included in like the main staple tech plays. It's just not. It's just not $1 trillion name. It's not in the AI discussion in the sense of like the way Nvidia is. It just sort of is like it's not a not favorite, but it's not in the top, like basket that investors go to in good times and bad. Sort of there. I will say Netflix has a really interesting position within the stock market though, because in some ways I kind of view its business as like recession proof. Whether like the economy is good or bad, I think most people will like find a way to justify the monthly cost of a Netflix, and it is like in the whole scope of things, like it is cheap entertainment compared to like basically anything else. But that doesn't mean like its stock is recession proof, and we saw that in 2022. It lost like I think it lost like 3/4 of its value in and it got to the point where like the firm was churning a profit. Its valuation was like being measured on a price to earnings ratio. It was like I think it fell to the single digits. I remember at like one point writing a note on it being like, I feel like Meta and Netflix are value plays now, which is a really weird thing to feel.
Wow.
After all those years of their growth. But yeah, it's as a really interesting position in the market in my mind, just in the way that its business model is, but how its stock isn't necessarily can be disconnected from that reality.
Yeah. Brad, I'm curious, how long have you been at eToro, and what has been, you've probably seen a lot of these waves of, I feel like there's these movements within retail investing that happen. I'm just curious, like what has changed the most in your view, being in your seat, or what has surprised you the most in your time there so far?
Honestly, my probably speaking and how investors approach markets and I think you mentioned it kind of earlier in the show. It's like some people on the platform are are wealthy. They have large accounts. They are comfortable with risk and turning their portfolio over. They're fluent in in options. And then you have other investors, like you said, just are new to investing. They have a few $100s in their account. They're just kind of there to dip their toe in the water, and just sort of that real range that you work with clients. Like again, some who are like very sophisticated, and others who are, asking how limit orders work. So I think you just see such a dynamic range, but all of them have the same common theme, which is like I'm here to learn and I'm here to make money. And the way that they go about that is, changed from I've been with eToro for like about 2 years now, and for the most part, so I came in 2023 when we were technically in a bull market, but it was really the Magnificent Seven and Eli Lilly doing all of the lifting, and for the most part, all the other 490 stocks were struggling. And so in those years, we saw our retail clients do really well because they have an affinity for Mag 7, and that group did really well. But as it kind of evolved into AI and a new leadership group, you sort of see that the Mag 7 like leech some of their momentum from retail. I think they did start to go into some of the AI names, whether it's just a hot AI name in the media or if it's more profound in the chip space or things like that. So it's interesting watching their trends for sure.
Yeah, and the learning curve, like Shy talks about quantum a lot. Like that's a whole new muscle then. Hey, I like this streaming player. So it is that constant evolution and learning about these are industries that we don't like interact with. Like there's no the only like the Google has a Gen AI product that consumers use, but when you talk about something like a Palantir or something else, much different. We have a few minutes. I want to get to one headline I just spotted going all the way back to the ongoing trade war. New report from the Center for Strategic and International Studies warning that the U.S. is not going to be fully able to replace rare earth supply from China. And I spotted this in the context of our trending page on Stocktwits because one of the top trending tickers right now is USAR, U.S. Rare Earth Inc. So not surprising, those are probably correlated. And obviously we can toggle over the what's trending feature and see that it's due to increasing interest in domestic rare earth production. I'll start with you, Bret, and then I want to get your thoughts, Shy. But Bret, is this like another example of potentially like what could be seen as like a boring play, but something that investors might latch onto just as a reactionary move?
I mean, you could definitely. I mean, I think investors like they see what's trending, they see what's in the news, and they look for opportunity just solely based on the potential for it. I mean, we've seen it. Whether it's like you just mentioned, quantum stocks was another. They're volatile, but I think investors kind of latch on to that volatility as a possible opportunity for themselves. I'd say like rare earths are out of my lane for sure, but I think it just kind of speaks to the ongoing situation with global trade. We're seeing volatility, be it in these stocks right now, but it was tech a couple days ago. It was autos before that. And really, we're seeing the volatility. It's not just U.S. stocks or global stocks. We're seeing it in the currency markets, the fixed income markets. It's just making a really difficult environment. And days like this, like USAR. I mean, hopefully the longs are getting rewarded on that one. And they were able to get an opportunity out of it, but it's tough. I mean, it's a tough tape without a question.
Yeah, both of you have made a point out of my lane. I feel like that's the world we're in. Like these things that are popping in any given day. Like I don't know, a few months ago, tariffs were out of everyone's lane too. So we all have to sort of be open-minded and curious. And Shy, we talked briefly about the rare earth thing with China, but just like thoughts on, I know that impacts like EV semis. Like, are you following that piece at all of the core products needed as the basis of some of these companies that you care so much about?
I mean, I think EV business is struggling for many reasons. Like that is one component that's like, ugh, that could be a headwind that will affect cost of goods. But also, I think that the lack of the deflationary demand for hybrids is what's causing the EV, like, to prevent the EV adoption explosion. Because like a lot of times, like people, the difference between hybrid and EV is like the first 60 miles, like you can essentially go if you're a hybrid, like you're more than fine. You don't need a full EV in the first 60 miles of your car. People commute to work like within 10 miles away from their home. Like, why do you really need? Nobody makes long distance commutes anymore. I think I don't know, COVID kind of hurt EVs where like people even work remote or they work somewhere where they go into the office maybe once, twice a week, and even then it's kind of close to their home. Like, there is a lack of needing EVs right now. Like, you just don't. Hybrid just does just fine. So that combined with the price elasticity that is going to be an issue now because of this high interest environments with the consumer demand on like, do I really need an EV? I don't own a home. It's really hard to own a home. I don't have any charging stations in my apartment building, townhouses because I can't afford to buy a home. Like I can't install my own charging stations. There's just so many different headwinds that it's becoming like put on the sidelines a bit. So the rare earth comment, like I think that's why MP Materials, like ticker MP, is doing really well because they're that's a U.S. rare earth producer, the biggest in the world. So I think that's kind of why they're catching a bid. That's one of the levers that the East can pull, obviously. But I do think that the East also is controlling the EV space really well. That's kind of the EV is doing really well over there. But yeah, look at this chart for MP. Like it's just that's people talk about gold as showing a lot of relative strength. Like rare earth material via MP is like whoa, that's it's hitting a 1 year high. So that's definitely the U.S. rare earth play. But yeah, I was really I was very bullish on EV a couple years ago, but that's kind of deflating a bit as time goes on with new information and the demand. Just I don't see the demand being there right now.
Yeah, it's fascinating to see purchase demand and as well as investor demand, which is why, Bret, it's great to have you. You'll have to come back. I have a million more questions about things you're seeing, which I'll have to ask you about on the side. But we really appreciate your time today. And Shay, good to see you as always. We will be back right here tomorrow at 9 a.m. Eastern on X, in the Stocktwits app, YouTube, LinkedIn, all the places. Thanks so much again, guys. Great to have you.